That's right, Romaine, and you mentioned it earlier. PacWest Bancorp, which is a regional bank ironically based in Beverly Hills, where you are, Romaine, is falling in after-hours trading. It's tumbling right now by 42% after saying it's weighing strategic options, which basically means it's looking for a possible buyer. So we wanted to bring in Herman Chan, Senior U.S. Regional Bank Analyst for Bloomberg Intelligence.
In today's video, we're going to take another look at the regional banking sector. After the fall of First Republic Bank, we now have PacWest in ICU basically on its deathbed. The thing we want to pay attention to today is the media really giving us the real story? Are they telling us the truth about what's really impacting the regional banking sector? Let's take a look at what they have to say.
What do you think it is that sparked this latest round of perhaps depositors pulling out money? Is it the stock price falling? Is it First Republic being absorbed by JP Morgan?
Yeah, unfortunately, with the market being so negative on regional banks now, after the failure of First Republic, the spotlight really shone to other banks like PacWest, and the share price decline yesterday probably spooked some of the depositors to exit the institution, is my guess.
That was an interesting explanation. But do you really think that is the truth about what's happening here? So if we look back at what happened with First Republic Bank, JP Morgan basically got a sweetheart deal to consume the assets of that bank. There was all kind of guarantees and loans and things of that nature. The FDIC is bending over backwards to make that deal happen. So with PacWest trying to facilitate a sell of itself, kind of similar to what First Republic was trying to do, nobody's going to step up to that plate to rescue that bank if they're not going to get the same treatment from the FDIC that JP Morgan did. So the question is what's the likelihood of that happening? First of all, the optics of that would look really bad, right? If the FDIC is coming in and doing all kind of sweetheart deals for big banks to consume smaller banks, it's going to have a very odd look to the public, right? Bank bailouts, right? So the political lens in this has some part to play in this. The other thing is that the FDIC has basically drained its coffers trying to hold this situation together, and they are paying a significant amount of money to have JP Morgan come in and consume the assets of First Republic. So when you take a look at what's going on with PacWest now, and the fact that they're not able to find a buyer and the government is not willing to step in to help facilitate that transaction, it's curtains for that bank. It's only a matter of time. And they're not the only one. But if you're paying attention, they're not really giving you what's really behind all the chaos that's happening in the regional banking sector. So let's continue.
Okay, so that's where I want to go to next, because so many people say the stock price is not the balance sheet. It does not reflect the balance sheet. Yet we see time and again that when the stock price tumbles, something happens and the bank is forced into this defensive position. Can you explain that connection?
Yeah, in a lot of ways, it's the dog wagging the tail wagging the dog is the expression, right? So the stock price can be a vote of confidence for a bank, because really banks are require confidence for the institution to thrive and survive. So if that confidence leaves, then depositors can potentially leave that balance sheet and really destabilize the entire operations of the bank.
So once again, we're hearing that word confidence being thrown around, right? And as I stated before, the whole Western financial system is a game of confidence. The currency is backed by the U.S. military, and that's what they also refer to as the full faith and credit of the United States. As long as they have a paper printing press, they'll always have money to pay their bills. The value of that money is a different story, right? And so once a bank loses confidence, it's basically curtains, right? There's too many other banks to bank with, but if you really pay close attention, they're not really explaining to you why is it that there's so much turmoil going on in the banking system. They talk about stock prices and how, the stock price falling is ruining the confidence. I don't really think that's it, right? And so it really is a deep discussion when you really think about what people look for when they're using a bank, but also how do interest rates play into that, right? And so we're going to get into that. So let's continue.
So talk about how the FDIC fits in here, because they kind of took the First Republic seizure very slowly. They tried to wait it out and see if a buyer would emerge. How do you think they'll proceed with PacWest, given that the FDIC needs to replenish its insurance fund?
Yeah, that's a good question. The regulators, in conjunction with the largest regional banks and the largest banks in the United States, tried to save it with the $30 billion deposit injection. Unfortunately, ultimately, that wasn't a successful venture. I'm not sure we're going to see that same sort of attempt for further banks down the road. So maybe the FDIC would come in and be a bit more proactive in dealing with these potential troubled institutions going forward.
That was really interesting what they had to say about the FDIC, but I think it really does come down to a case of moral hazard, right? And the first deal that they did with First Republic, that was basically a sweetheart deal for JP Morgan to come in and scoop up all of the good assets from the bank, and in exchange, leave all the trash with the government and the taxpayers. Here we are again with another bank in a similar situation, but the financial position of the FDIC is much different, right? They have a budget too. So the question is does the FDIC have the ammunition it needs to facilitate the same kind of deal, which is what the market is looking for, to have someone step in and buy this bank? I don't think so. So this is going to be very interesting to see what does the FDIC do this time, when this bank finally rolls over and basically is dead. So let's see what else is unfolding in this story.
Another domino could potentially fall in what has been a testing time for the financial sector. Here with the details is Yahoo Finance's Akiko Fujita. Akiko.
Good morning to you, Inez. Well, after the failures of early March, banks have been on high alert over the state of the financial sector, and specifically the so-called regionals. And that is what we're talking about this morning. It all, of course, began with the collapse of Silicon Valley Bank earlier this year. They, of course, were a key lender to the tech startup community. The Fed has been given some of the blame for starting the turmoil by raising rates high and fast. SVB was largely hit by interest rate risk. Essentially, when bond yields go up, the value of the bonds fall, and they were sitting on a lot of them.
So we're starting to get another piece of the puzzle now when they talk about the rapid rise in interest rates. If you think about the bank's operating model, right? Banks make money by doing loans, right? And what they do is take excess cash and they buy securities, right? But the securities that they buy are primarily government securities. And banks make a lot of money off of making loans, right? Whether it's residential real estate loans, commercial real estate loans, auto loans, personal loans, right? They're all in these different categories. So when the banks issue loans against real estate or commercial real estate, the value of those properties is very important because that's an asset that sits on the bank's balance sheet, right? So when you, as a customer or any other person or company comes in and makes a deposit in the bank, they don't sit on that money. That money goes right back out the door and they leverage it up to go and make loans and to acquire assets, which is the debt, right? But if you look at what's happening in society now with commercial real estate and the vacancies, people not paying their mortgages for quite some time, so there might be a situation there. You have property values falling. And so when people come and take their money out of the bank has to raise capital in order to stay solvent. And the problem is that the assets that are sitting on the bank's books are not worth what they paid for them. So they would take significant losses, right? And in addition to that, you got to think about what's happening with these high interest rates, right? When interest rates were next to zero, banks basically held money for free. Well, in today's world, money isn't free anymore, and we're going to hear more about that.
That's the story with SVB. Now, earlier this week, First Republic became the second largest bank to fall as the contagion grew and its deposits slumped. And this morning, PacWest Bancorp is apparently on the chopping block. Shares plummeting. You see it down more than 50% here following confirmation of a Bloomberg report that it was weighing strategic options, including a sale. Now, PacWest looking to get out ahead of the messaging here to ease some of the jitters in the market, saying in a statement that the bank has not experienced deposit flows that are out of the ordinary, adding that the bank's cash and available liquidity, in their words, remains solid and exceed uninsured deposits. We've also heard heard from the company as well, trying to sort of ease some of those concerns. Now, analysts were quick to take action as D.A. Davidson downgraded the stock to neutral. Meanwhile, other regional bank names are also falling to the red.
So we're now getting another piece of the puzzle as they've provided us with a list of banks that are basically on life support. Now, if you think back, they told us with First Republic that was basically it. Once that bank failed, the crisis was over. Nothing to see here. Don't pay attention to the burning building in the background. But as you can clearly see, we have 4 more banks that are basically on death watch, right? And what's fascinating in all of this is the sheer size of the bank failures this far. It's in the hundreds of billions of dollars, and we're just getting started. I'm pretty sure that when the end of this happens, it's going to blow everybody's mind at the sheer size and how much money has been lost due to the rise in interest rates.
As PacWest reignites banking fears. One of the ones we're watching specifically is Western Alliance. Shares there halted in this session. You saw it take steep cuts earlier in the week. And we have also heard from Western Alliance reportedly saying that a report of a deal is absolutely false, specifically as it relates to that bank. Now, signs of worry over PacWest Bancorp came shortly after Federal Reserve Chairman Jerome Powell reassured Americans in a press conference just yesterday on the soundness of the U.S. banking system. Take a listen.
The U.S. banking system is sound and resilient.
Nothing to see here. Don't pay attention to that burning building behind me. You don't see that. Everything is fine. Just keep calm, keep it moving, and don't worry about nothing.
We will continue to monitor conditions in the sector. I think that the resolution and sale of First Republic kind of draws a line under that period of, is an important step toward drawing a line under that period of severe stress.
Now, despite those comments from Jay Powell, in light of the new stress point that is PacWest, Pershing Square Capital Management CEO Bill Ackman is now sounding off on a warning on regional banks, saying, quote, banking is a confidence game. At this rate, no regional bank can survive bad news or bad data as a stock price plunge inevitably follows. Insured and uninsured deposits are withdrawn, and pursuing strategic alternatives means an FDIC shutdown over the weekend or over the coming weekend. Yeah, it's been interesting to see just the diversion in terms of comments coming. The big banks, you mentioned Jamie Dimon. We also heard from Citi's Jane Fraser earlier this week saying that, look, the fact that big banks are able to step in, the fact that they are able to step in and essentially rescue some of these regional banks points to the fact that this is not a repeat of 2008. That's not what's going on right now. At the same time, Inez, I know you've been talking about this a lot as well, but since SVB, there's been a lot of conversation about how rapidly these things could really pick up, partly because of digital banking, partly because of social media. Things are happening at a very quick pace right now. The minute somebody hears that potentially one bank could be on the chopping block, there could be some concerns about deposit outflows, that tends to get accelerated really quickly.
With modern times, it is very true that things do move very fast. Digital banking is now a norm where, financial transactions can happen instantly. And so with social media and being very well connected, news does travel fast. But make no mistake, I don't think that these are the reasons why this stuff is happening. All they're explaining to you is what the capability is, right? If one of these banks get in trouble because of modern technology, the deposits can leave the bank very quickly. And banks do not have the capability to recover just as fast, right? So this is leaving a hole in bank balance sheets and causing a lot of turmoil. Then on the equity side, because these companies are publicly traded, or these banks are publicly traded, the stock price goes through the floor, right? And I'm pretty sure that there are billions of dollars being made as these banks are being heavily shorted. And it's probably what we need to look into is what is the short interest in the banking sector for these banks that are on death watch, right? We do have a list, and I'm pretty sure that information is available to see just how much these banks are being shorted, because it's common knowledge that they are in financial straits, deep trouble, and will potentially fail in the very near future.
Listen, Dick Beauvais, I don't want to be too critical on Jay Powell, okay? I mean, we know interest rates are probably the gasoline on maybe a fire that was already there due to bad management, like Michael Milken. I don't know if you saw our interview with him yesterday. He said this is just basically banking 101, and they screwed it up. Is it possible the banking system that Powell described is, quote, strong, but at the same time, these stocks clearly are not?
The banking system is not strong. Banking system is dealing with a systemic problem, no different than what we saw in 1986 with the S&Ls. The problem is that interest rates are going up, and when they go up, they cause the cost of deposits to rise at a rate which ultimately reaches the point where the banks are paying more to bring money in than they are getting from the investments that they have. The second thing that the rise in interest rates do is they drive the value of fixed rate assets, treasuries, home mortgages down. And what that does is it robs the banks of liquidity, which means that when the depositors come banging on the door looking for their money, the liquidity is not immediately available because it's wrapped up in areas which can't be accessed, quickly, number one. But number two, that the value of the assets are not what they say they are. Number three, the banks are cheating in the way they report their balance sheets. When you pick up the financial statements of the bank, that financial statement is not what the bank owns. That bank financial statement is showing more assets than the bank has. It's showing more equity than the banks had. And thank God for short sellers, because what they're doing is what the Federal Reserve, the FDIC, and all of the regulators should have been doing. They're cleansing the system.
Wow, that was pretty refreshing to have a brief moment of truth in all of this. In the previous segment, the lady had made a comment about 2008 and how this situation is not like 2008. I have to agree with her. It's not like 2008, but the results are basically the same in that institutions will fail. And so this person is giving a very good explanation as to what's going on with these banks. So let's talk about this a little bit more. All right, so we're going to start with deposits, right, and the rise of interest rates. So the statement that he said that banks are losing money because it's costing them more to hold on to deposits, right? So with the rise in rates, there is now a competition for money, right? So there are a lot of places where you can actually earn, more interest on your money than what the banks are paying. So with this competition, banks either have to pony up in order to hold on to the deposits, or people start removing their money from the bank. And it's not just people, it's also small and medium-sized businesses. They have deposits too, right? So what happens is that now with the assets that they have on their books being at low interest rates, and with the Fed raising rates, they're basically in combat with each other, right? So even I have a mortgage that's less than 3%. So if you really think about that, the assets that the banks have on their balance sheet are not producing enough income to offset the cost of them holding deposits in the bank. The other thing too that he talked about is the value of the asset. And that's also important, right? So it's not only the rising interest rates that is putting pressure on prices for commercial real estate, but you also have the vacancies, right? And so with cap rates exploding, vacancies on the rise, we know that we're nearing almost 50% occupancy in the office sector. There's a lot of real estate out there that is not worth what they were financed for, right? So you have that, and you have government bonds. And the banks were buying government bonds very long ago at very, very low rates. So what happens is now that we have this competition for capital and the money can quickly leave the banking system, as soon as it happens, banks have to raise money in order to meet their capital requirements. And if they can't, they become insolvent, right? And so as people get wind of this and you're invested in the bank as an equity holder, you don't want to get hosed. So you basically sell your stock. Then there's the short sellers, right? They're people that are very smart, that are watching on what's going on with the banking sector. And we just got a list. There's a lot of public information out there to tell you what banks are in trouble. They start shorting and putting pressure on these banks, and they're making a ton of money in the process. So that goes back to where I'm saying is when there's crisis like this, there's opportunity. And the question is what are those opportunities? Shorting these banks, I'm pretty sure people are making a pretty penny doing it, right? Is it risky? Yeah, it is. But at the same time, look at what the reward is, right? It's not investment advice. All I'm telling you is what I'm observing, right? So we know there's a competition for money. We know that it's costing banks a lot of money to try and hold on to deposits, and they're not winning that battle because they're losing deposits left and right. The question is where is that money going? Now, what I think, and this is just my personal opinion, is that because money market funds are paying a pretty good interest rate right now in comparison to the past, a lot of deposits are leaving the banking system and going into these money market funds. I'm going to look for some charts and post some information about money market funds on Twitter. So if you want to see a difference in the rates between what the banks are paying and what money market funds are paying, then I'll post that information there. You can see it for yourself. But it's fascinating, right? Because banks for a very long time have gotten away with paying people nothing for their money, right? And those days are over. The Fed is already coming out and saying that they're going to keep rates higher for a very long period of time, okay? An extended period of time. And what that means is that banks are going to struggle because they basically are not in a position to pay people what these market rates are. So even with the stock market, if you can get nearly 5% in a money market fund, would you rather do that and have basically no risk to your capital? Or would you rather risk it in the equity market where companies are not doing well, we're going into a recession, the stock price can go down and your capital is at risk, right? So, rising interest rates poses a lot of challenges to the economy, right? In more ways than one. We look at the cost of money, right? When going to get an auto loan or using your credit card, the rates are very high and that's causing people to slow down. But in the banking sector, they get impacted by it too. And so what we're going to start seeing is a tightening of credit, right? A tightening in lending. Banks are going to really, really have to tighten up because they realize that these rates are very high and that it's a very strong likelihood that people will default on any loan that they give out, right? They really do have to do a very good job at vetting people if they're going to take on that risk. And so what that means is less credit available to the public. And that is going to have a very significant impact on the economy going forward. So as we roll into the second half of 2023, look out below because it takes a while for this stuff to sink into the system. But eventually it's going to have to bubble up to the surface. And when it does, boy, is the news going to be crazy. So with that being said, I hope you guys liked and enjoyed this content. If you did, please give me a thumbs up. Please give me a thumbs up. Subscribe to the channel if you haven't subscribed already. I know about ninja watching. I do it often myself. But when I do find a good channel, I do subscribe to it. So if you like the content and you're not a subscriber, please join the channel. Would love to have you. Also, don't forget, check out my Twitter feed because I do post interesting information there along with, pictures of charts and stuff to kind of validate what I'm saying. And with that being said, I'll see you on the next video.